back in April, there were all these tariff proposals, and the market freaked out. So equity sold off. Credit markets freaked out, basically higher spreads. And right now, estimated forward tariff rates are pretty similar to what they were back in April before the de-escalation, and yet the market is at all-time highs. Credit spreads are narrow. There's really little concern. Um, and so my general view is that there's more risk from tariffs than is probably being priced in.
Mm.
Um, and so short of a major reversal, I do think that it'll be an ongoing friction against the US economy and then particularly tariff heavy sectors. Most analysis so far, like when you look at import prices, they're not down and they're measured pre-tariff. And so there's not much sign that foreign exporters are absorbing the cost, which means most of the tariff revenue is coming from some combination of American consumers and American businesses. There's also the fact that because tariffs were telegraphed in advance, many importers front ran the tariff, so they pulled in extra imports in quarter one, and that gave them some degree of a buffer against, as kind of the U.S. Treasury takes in. I think they reported over 150 billion in tariff revenue. Well, they also, because the ex importers pulled in a lot of products ahead of time, that gave them some buffer before they have to really kind of pass on costs to consumers.
Back in April, tariffs spiked and markets freaked out. Stocks dipped, credit spreads blew out, and everyone braced for impact. But a few months later, markets are at all-time highs. Feels like the danger passed, right? Wrong. Lynn Alden says the damage already hit. Nearly $150 billion in tariffs were quietly extracted from US consumers and businesses. But importers front ran the hikes, stockpiling goods, so the pain didn't show up in GDP right away. It masked a recession, not prevented one. Now that buffer's gone, Ford's struggling, consumer prices are rising, and the slowdown is surfacing, sector by sector. This isn't a forecast, it's a post-mortem, and you were the collateral.
But if the tariffs do stay in place as they are, I do think that'll increasingly trickle out to consumer prices. And so most of this is at least a mild drag on the U.S. economy that somewhat offsets other things that are stimulating. So we're still running pretty large structural fiscal deficits. Nothing stops this train. That's still the background situation. But then that is, at least around the margin, somewhat offset by these structurally higher tariffs. And most of the deals we see, like we saw the one with Japan, where we place tariffs on them. Certain sectors are more targeted than others. There's generally headlines around, say, big investments that Japan's going to do, but when you dig into the details, mostly it's lending, which in many cases they're already doing. That's generally how this mechanism works: is that the U.S. runs these really big trade deficits with the rest of the world. They take the dollars and then they often buy our assets, or deploy their credit into our assets. And so I expect that to continue. But basically, I think that we have this new kind of annualized multi-hundred-billion-dollar tax that is roughly spread between American consumers and American businesses. Obviously, some sectors are more impacted than others. So we see, for example, Ford talking about the tariffs, but we don't really see Microsoft worried about the tariffs. And the reason that's notable is when you look at, say, the way these companies kind of operate is Microsoft is something like 100 times the market cap of Ford. So when we're talking about investing, we're talking about the stock market, it's all about Microsoft. It's not about Ford. But when we
Mm.
look at the broader economy or socio-political situation, Microsoft doesn't even employ twice as many people as Ford does, despite being 100 times the market cap. And so things that slow them down or impair them, while they might not be as spectacular in the near term on the stock market, they do tend to trickle out quarter by quarter as we see some degree of stagnant economic conditions. So I'm currently in the camp that views gradually decelerating U.S. economic situation. Uh, we don't have great seasonality coming up, especially by September in the stock market. So I do think that at least this 2 month window is a time for potential caution until we have maybe a little bit more clarity on what tariffs are going to look like going forward. The fact that they brought in something like 150 billion in tariff revenue has to be compared with the fact that the U.S. is a $30 trillion economy, right? So while that's a non-trivial amount, It's not as though that's going to shut down the economy. In addition, some of that was buffered by the front running I mentioned, where companies were able to kind of pull in stuff ahead of time. So even as new purchases are coming with tariffs, they generally had inventory that they could still sell at prior prices. So I do expect to see some ongoing consumer price pressures from this. I'll be watching like import prices pretty closely to see to what extent, if any, ex foreign exporters are absorbing it. So far, not much. When we look at the recent GDP print, one of the things that complicates this is that that tariff front running adds noise to the GDP figures. So if you remember, Q1 GDP was reported pretty weak. And that was negatively impacted by a lot of that import front running because when you have a big uptick in imports, that puts downward pressure on GDP. And because we kind of have the hangover from that, where there's like less importing now, that's actually good for Q2 GDP. When you look at final domestic sales, the portion of GDP, that was markedly decelerating in Q2. It wasn't a catastrophic print, but it wasn't a very strong print. Also, if you look at CEO confidence, it's been down significantly recently, which is not great generally for capex and hiring. And so overall, I wouldn't say there's massive red flags in the economy, but there's certain yellow flags. I've generally been in the pretty bullish camp through 2023 and 2024. And here in 2025 is kind of the first time in a while that I do have more concerns overall around both the state of the U.S. economy and stock markets. But that's still in the picture of we're still running very large fiscal deficits, which for many industries are a stimulus. So generally what I do is I look at things industry by industry, and I'm trying to determine, is that industry in a recession? Is it priced for a recession? Versus other ones that might be at risk for a recession but not priced for it. So I generally view sector by sector, industry by industry, rather than the whole economic picture. The part that I think is worrying is the labor market, which has not shown signs of cracking yet, but the flywheel could start to go negatively against it. So right now, no major red flags. Uh, but I think that as we've gotten past the buffer from front running of tariffs and the inventory, to the extent that these stay in place for another quarter or two, I'll be watching the GDP pretty closely because I do have increasing concerns around broader deceleration. I do think there's a fundamental shift, and people said the same thing around Bitcoin. They were like, Bitcoin's a zero rate phenomenon. It won't do well when you have high rates, and here we are at high rates and Bitcoin six figures, and gold, comfortably well over 3,000. Um, what changed was that we entered fiscal dominance, and so when you have pretty low public debt, and most of the money creation is coming from bank lending, when you raise rates, you generally slow down bank lending at a bigger degree than you blow out the deficit. On the other hand, when you have over 100% debt to GDP on the public sector, and most of the inflation is coming from monetized fiscal deficits, not from excessive bank lending, when the Fed does what they're doing now and they raise rates and try to keep them high, they actually blow out the fiscal deficit by a bigger number than they slow down bank lending. So they don't, for the most part, they don't greatly slow down total credit growth in the way that they're trying to. So basically, when they sharply raise interest rates in 2022, that temporarily brought everything down. But then as soon as we started to get some of your treasury offsets, we started draining the reverse repo facility. We were not really, even though the Fed was remaining hawkish around the margins, a lot of conditions were still improving at that point. And that's generally a sign of fiscal dominance, that even high rates don't really do what they used to do in terms of slowing things down. Sometimes they just add fuel to the fire. And so I think that's structurally what changed this cycle. And I think that's a more persistent regime that we're in now. That's not even a near-term thing. That's just kind of structurally the environment that we're in now. And so there's still be correlations where if the dollar goes through a strengthening period as it has in recent weeks, that can put downward pressure on gold and certain other assets. But in the grand scheme of things, I think that correlation, that interest rate correlation, is severely reduced now, and it's more about what's happening fiscally. how independent is the central bank perceived to be, and factors like that more so than just that interest rate correlation. In terms of raw return potential, I'm more bullish on Bitcoin, and that's worked out well for the past 5 years. Just because, gold's a 20 trillion plus asset, Bitcoin's a 2 trillion plus asset, and I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So, in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so, on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is because I've been a bond bear, I basically said if you take a 60-40 portfolio and think, how can I improve it for a period of fiscal dominance? Well, one, you can take out some of the bonds and replace that with some gold, for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as different, replacing different parts of the portfolio. I think gold is more of a, uh, it's more of a competition for bonds, and Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities.